1. Go, go, go.
We're on. Excellent.
Excelente.
Man, I'm glad that week is over.
Right? It's been a crazy week.
Yep.
In the market, otherwise.
Yes, sir. Absolutely. I think we should only talk about the market, but...
We shouldn't keep all the other stuff aside.
Yeah. So...
We're going to be doing commercials for Pellegrino here at some point.
I know, right?
We got
This is some
Polar
good
and
stuff.
Pellegrino going everywhere.
Yeah.
The office that we rent space in provides them.
Coffee, Pellegrino. It's got a little gym. A couple blocks from my house.
Oh, a gym is in workout gym.
Yeah, gym. Workout gym.
They also provide a little gym beam every once in a while.
Oh, that's true, too. That is true, too.
Yeah.
Indeed.
It's not a bad place to have an office.
No, it's kind of nice. I kind of like it.
They're full, or we tell who they were, because otherwise people would have called.
Yeah,
and be like,
yeah, that's true. They're full.
I was actually like preaching the praises of it, and somebody tried to get an office here, and they were like, "Nah, we're full. We got a waiting list."
Yeah, we got lucky.
Yeah, we did. Yeah, we did. All right, man. What we got
so
going on this week?
let's launch into it.
Let's do it.
It's been quite a week. For anybody that's been following it on Facebook, there was lovers and haters. Everybody came out this week. At the end of the day, we are a financial education service, and
Is that what we do?
that's what we do. I mean, at the end of the day, that's what we do. We're trying to show that technical analysis, Elliott wave, the moving average lines and trend lines and all that can help you make good decisions to help you manage risk in your TSP. That's it.
Yep.
Like, I don't have a methodology that is the way and every other way is the wrong way. It's just not the case.
Yeah.
Yeah.
I would say that the one thing that makes you stand out among people that do technical analysis is you have a very uncanny ability to keep emotion out of it.
I try.
Yes. Yeah. I mean, you still get emotional.
Yeah.
Right. I mean, I see you kind of toil over stuff, but at the end of the day, you make practical decisions, which is like, hey, this is what the data says, man. You got to do it. Right. And that's very difficult. A lot of people are still going to be, emotional about their decisions, meaning, I got a fear of missing out is the big one.
It's a big one right now. Yeah, it's a big one.
And it's like, you know what? It's got to do what the charts tell you to do. And that's
because
it.
if the market had continued lower on Friday instead of rebounding off the 50-day moving average, which is awesome that it did, if it had continued lower, the emotional piece, the fear of missing out, would have flipped real quick to the fear of more losses.
Right.
And as the months go by,
it would have been a really rough weekend for everybody.
Yeah.
If that would happen. It might still be a rough weekend for some because they're still figuring out what they should have done.
Yeah.
But if it had gone below the 50-day on a Friday, wait until Monday to see what happens. It's just gut-wrenching.
Right.
And we're not, there's nothing gut-wrenching for us right now because we're safe.
No, we're good.
Yeah.
We're going to get to all that, but now we're good. All right. So, wild week on Wall Street. C Fund, it could have been much worse. It was only down a little over half a point. S Fund down 2.28%. I Fund down 2.42%. And the F Fund was in the green by 0.16%. All right. So we're going to look at the intraday chart first and see how that kind of gives us an inkling into what might happen at the beginning of next week. Then this thing called consumer sentiment, which is really interesting. Michigan University came out with this thing this week that, again, might shed us a little light on what is going to be happening down the road. And then we've been talking about this certainly this week and last week. I've been wanting to do this for a little bit. There's two long-term possibilities in the Elliott wave count. And we're going to go through that. The bonus chart is the NASDAQ, which I think probably most people know. The Dow Jones Industrial Average, the NASDAQ, and the S&P 500 are the three big indexes in the United States. The NASDAQ is big cap tech, as opposed to like the S Fund, which is mid cap and small cap. NASDAQ is big cap, meaning Amazon, Netflix, Apple, Google, those kinds of things. And then we'll look at the 18-month weekly charts. All right. This was last week's C Fund 1 month hourly. So at the end of last week, we were in this flat right here. The market had come up for 1, A, B, C for 2, and we're in this 3, and everything looks good. We had finished the Friday at the last hour, because each one of these ticks is 1 hour, right? So the volume in the last hour was up, and it was really good. It was a great way to end the week. Not this Friday, but last Friday. Then Monday morning happens. So here's where we were, that flat from Friday before last, right? Monday morning, the market gaps down on the open. And as we talked about, if you're a subscriber to the site, it wasn't the C fund. We did an alert last Monday morning because of some technical breakdown in the S fund. And it turned out to be great for us, actually, because we got out of the stock funds on the Monday. This was the closing high. This is the closing price on the Monday. So we got out at the top price that we could. It was luck, basically, because the market had dropped down, and by the end of the day recovered back to a new all-time high. So we got kind of lucky because we got out at the very top.
But I mean, lucky, yes, but you basically knew where your line in the sand was, and you said, hey, I'm going to get out if it does this.
Yeah, it didn't matter what was going to happen during the day.
Exactly.
We were out.
Yeah.
What I mean by lucky is that since you have to have your reallocation in by noon to get that day's closing price,
right.
Sometimes the afternoon goes against you,
yeah.
right? Sometimes it goes with you, right? Yeah. So in this case, we got out on an up day. So some people would think that's great. We got out on an up day. And
we were getting out either way.
Yeah, we were out. Yeah. We were out by noon. So whatever happened by the end of the day, that's what happened. So at any rate, the market comes down during the course of the week to a low down here at 43.70. By Thursday, it had recovered a little bit, and then Friday dips back down and has a pretty nice recovery back up to this blue line on this chart. It's 117 30-minute period, so it's pretty close to the 10-day moving average. So right now we're sitting pretty much right on the 10-day moving average. Okay, so here's a couple things I just want to throw out about this chart that might give us an indication of what happens next week. This was the one, right? And this 1, 2, 3, it's a consolidation. It's a corrective move. It's not an impulse move, because we always talk about how 5 moves, right? 1, 2, 3, 4, 5. They're impulse moves. So whether the market's going up or down, when you see five legs, it means it's going in that direction. When you get a 1, 2, 3, it's consolidating. So we had this move up here, and we had a 1, 2, 3, which consolidates this move so that it can move higher. And we moved higher in 1, 2, 3, 4, 5, right? So on an intraday basis, because this is 1 month where each tick is 30 minutes, we have 1, 2, 3, right? We didn't get 4, 5. So that means this move that we had last week is corrective. It's not an impulse move. And the reason we know that is because the Elliott wave theory says that this is the 1, the 2, this is the 3. So at that point, we're looking for a 4, 5, right? If there's 3 rules, 3 in stone rules for Elliott wave. And we're going to get to that actually in a minute. But one of those rules is the 4 leg, which would have been this, cannot get above the 1. The 4 in a corrective 5 leg, the 4 can't break into the area of the 1. So we know, in terms of Elliott wave, that 1, 2, 3, this isn't just a high 4 because it broke that 1. So now we know this is a 1, 2, 3. So it's corrective. So based on the Elliott wave, and I'm not saying this is going to happen, I'm saying based on Elliott wave analysis, this is a 1, 2, 3, and we should keep going higher, at least on an intraday basis next week, based on the Elliott wave theory. I'm not saying that that's what's going to happen. I'm saying that is the Elliott wave theory of how it works.
A lot of disclaimers.
A lot of disclaimers, yeah. Not that it's going to matter, but that's what it is. Okay. Consumer sentiment. This is really interesting. So this here is the definition of consumer sentiment off of Investopedia. But the most important thing to take away here, consumer sentiment is a statistical measurement of the overall health of the economy as determined by consumer opinion, right? It's how people feel toward their current financial health of the economy, whatever. Consumer sentiment has emerged as an economic statistic during the mid-20th century and has become a barometer that influences public and economic policy. It's kind of frightening in a way that the way people feel
drives policy.
Drives the policy. Yeah. That's the thing that really stood out to me. I'm reading this and I'm like, wow, really?
No, it has a huge impact. But I don't know. I'm kind of torn with it because, the stock market is just people's feelings.
Yes.
Right?
Yep.
It's fear and greed back and forth.
Yep.
It's buy, sell. It's pretty much how, now we say people. Really what drives it is institutions. Yeah. But those are still
people. But they're people. Yeah.
They're still people. Yep. So,
and they're algorithms, but people create the algorithms, and
right.
So you can't get away from it.
How people feel about a certain company or a stock or an index or whatever is what drives all of those actions. Yeah. And that's why there's patterns. Right. Because people have patterns.
Yes, they do.
Whether they like it or not, people have patterns. Yeah. And that's one of the things that's in our favor.
Yep, it is. It's the thing that how the Fibonacci numbers work. It's how all the stuff.
It's why I bought into technical analysis because I had a previous life as an Intel analyst. I would call myself a knuckle dragging Intel analyst.
Right.
I was not as smart as most of my analyst friends, but you pick up certain things, and there's a fundamental understanding of human behavior that and we knew it as law enforcement investigators also. People have patterns. You can't. You could try your best not to have a pattern, but you're gonna. You're gonna. And that's what kind of builds. That's what kind of starts the whole. Gives us the ability to do technical analysis.
Right.
Because if we were, I'd much rather call it human analysis of
the stock market.
Than technical analysis because that's what it is. Yeah. Yeah. You're analyzing human behavior in the stock market.
Yep.
Right.
There's Prechter is the guy that wrote the book about Elliott wave theory. Mm-hmm. He has, in the last, 10 years at this point, created this study, essentially, it's called socionomics. And what it does is try to show that sentiment is what drives the market and not the other way around. So most people think that when the market rolls over, then people react and they get all freaked out and I'm going to lose my money or whatever.
And that's kind of true.
It is true on the face of it, but you can see it on the front end before it happens.
Right.
And socionomics it's fascinating. It really is.
But that goes hand in hand with what we were just talking about with consumer sentiment. Yeah. It's become a and I see you come from, right? It's just I can't believe people's feelings
affect policy. That was the thing, because I would have thought that, feel how you want, but the Fed doesn't care about how you feel. It cares about the numbers. Apparently, it also it looks at the report from Michigan, University of Michigan's Consumer Sentiment Report. So are we back on the slide?
Yeah.
Okay. This is actually probably a good example of what Prechter will probably come out and talk about as part of socionomics, but University of Michigan does these monthly reports on sentiment, and you can see, there's some fluctuation here. But last month, that dip is pretty far outside the range. So what the University of Michigan says about it is consumers believe the economy's performance will be diminished over the next several months, but the extraordinary surge in negative economic assessments also reflects an emotional response, mainly from dashed hopes that the pandemic would end soon. So while the market is still going up, clearly the report is showing that people are already having a lot of concerns about the economy in general. And so, again, Prechter, in terms of socioeconomics, would say that this is a leading indicator that would portend that the market is fixing to roll over.
Yep. Yeah, it's definitely a leading indicator of something.
That's a huge, huge drop-off.
Yeah.
So we'll see whether it's the Delta variant or, people aren't fired up for Christmas this year. Well, I don't know, but it's a kind of and it's only one data point, right? It's only 1 month. If over the next couple of months it stays at 70 or goes, dips below it, it's going to be interesting to see how the beginning of the year unfolds.
And we'll be having our eyes on it.
Yep, definitely. Okay, 2 possible long-term Elliott wave patterns. I think there's only 2. And honestly, if you Google Elliott wave and what's going on right now in different technical analysts' opinion, there's only one. I haven't been able to find anybody else that is sees the count that I'm going to put up as my primary count. So it doesn't mean I'm right or wrong. I'm just saying the way I see the chart.
You see another possibility.
I see another possibility. Yeah, and so let's do it.
I'm intrigued.
This is the basic way Elliott wave works. If this is the first time you're seeing the show, we've done Elliott wave a whole bunch, but here's the basics. If the market's going up, right? The first leg happens. The second leg corrects some amount of the first leg. The first rule of Elliott wave is 2 cannot go below 1, which kind of makes sense because you wouldn't be going up. You'd be going sideways or down. So 2 cannot go below 1. 3 cannot be the shortest leg, right? Wave 3 can never be the shortest wave. And the third rule is, like we talked about on the first slide, wave 4, this point on wave 4 cannot go into this area of wave 1. Okay, wave 4 can never overlap wave 1. Those are the only 3 main rules that cannot be broken in Elliott wave. The rest of them are guidelines. Okay, one of the guidelines is this. There's a, I can't remember the term. Maybe it's in here. If you get a sharp move down in the 2, you're likely to get a not so sharp move down in the 4, or vice versa. So, and most of the time this is how it looks. Most of the time you get a deep correction in the 2 and a relative flat in the 4. But again, that's just a guideline. Okay. So here's what I'm saying is possibility number 1, and this is not what most people are considering is the count, but that's okay. 1, 2. Our 3 is an extended 3. So 1, 2, 3. ABC is 4, and we have a 1, 2, 3, 4, 5, which brings us to the 3. And we got an ABC for 4, and then we have a 5. So if that's the case, and because 2009 was the last major low, right? So if this is 1, 2, 3, 4, 5 for a 1, and then the COVID crash is the 2, because one of the things, let's see, the ABC correction ends near the wave 4 low. So the C right here ends up being pretty close to the prior 4. Okay? That's what we have right here. This correction, the 2, brings us down to the 4. So if that's the case, if the count is right, this is a 1, this is a 2, then in the big scheme of things, this is a 3. And we get a 4 and we get a 5. So basically what I'm saying is the market just keeps on going higher for the next, in the big scheme of things, not on a daily basis, right? This is a 14-year chart. So yes, we'll have ups and downs and some corrections and all that, but in the big scheme of things, the market goes higher. So what does that look like, kind of drilled in a little bit? We said that the pre-COVID high was the 1, right? COVID brings us down to 2. That means now we're in a 1, A, B, C for 2. We're in this 3 right now. At some point, the 3 ends. We get some kind of 4, and then we go higher. Okay, so that's my primary Elliott wave count. This is what we're looking for right now. An end of the 3 and into that 4. So if this count is correct, we get some kind of correction over the next few months. At some point, whenever 3 ends, we get some kind of correction over the next few months. Technically, it can come down all the way to just above the 1, right? The 4 can come down, but it can't break into the area of the 1. So a 4 could come all the way down to here and then still go higher. I actually don't think it will, but we will have some kind of correction for a 4, and if this count is correct, then we'll just keep going higher. All right. Again, that's my count. That's my primary count. This next one is everybody else's primary count.
And it's a little gloomier.
It's gloomier. A 1, whether you count the 1 here or here, it doesn't really matter. I count it here, 1, ABC for 2. Then this whole thing is a 3, and the COVID crash was the 4, and we're in a 5. If we're in a 5, the only rule, and this actually isn't a rule, it's a guideline, 5 has to get above 3.
It already did it.
And it already did it. 5 does not need to play out in 5 legs. That's not a rule. So if we look at this, it's already past it, and we could say 1, A, B, C, 2, and we're in this 3, right? But there's no reason that it has to be 4, 5 before it comes down, because all the rules for Elliott wave in terms of this count have already been met. So there, in terms of Elliott wave, there would be nothing wrong if the market started tanking tomorrow and we started doing like this, because wave 5 is already in place. So if that's the case, what happens? If this is the end of wave 5, we get something like an ABC correction, which brings us back down to the prior 4. And I think we were talking about it either last week or on one of the Facebook Lives this week, but a 50% retracement is pretty common on big bear markets, right? And so if we're at basically 4,400, 2,200 is 50%, and that's right at the prior 4. So I'm not saying that the market's going to crash 50% and it's going to go to 2,200 because that's the prior 4. I'm just explaining the Elliott wave and how it works.
Yeah,
right?
but I mean, both of these scenarios do call for a correction.
Yes.
One is larger than the other one.
Yes.
That's for me. That's
the takeaway.
Is that we're looking for a downturn correction.
Yes.
Right.
One way or the other. And it just so happens that in terms of seasonality, this is a perfect time for it to happen.
And if it
doesn't mean it will.
If it's a 5 leg, it means one thing. If it's a 4 leg,
right.
Or 3. I'm sorry, 3.
Right. And either way,
it
doesn't matter.
Yeah, that's the takeaway.
There's a correction on the horizon. That's all that matters.
My problem with this chart, right?
Yep.
If you can back out to the one that kind of shows the longer term, is the one before that.
Yep.
Yeah. So my problem with this chart, regardless of the Elliott wave,
right?
All right, is there's just no way that is sustainable, that growth, right? We've talked about it several times. If you draw a trend line, wherever you want to draw it,
yep.
right? If you draw a channel and you say, okay, this is kind of the general trend of the market.
Yeah.
And all of a sudden the angle just, draw that for me because I can't do it.
Yeah.
so that people can see what I'm saying.
Yeah, you get this.
You got that going on.
Angle, and then all of a sudden,
bam, That's just not sustainable. Go find anywhere in the history of the market where that's sustainable. It's not going to be. So that's my problem, right? Is that even just if I didn't even know what Elliott wave was, right?
Yeah.
And I'm just following the kind of the daily moving averages, and I'm drawing my trend lines, which is pretty much where I'm at. Like I leave the Elliott wave and the Fibonacci to Jerry because he understands it a lot more than I do. I get it. When I'm doing it by myself, I get lost a little bit. And so when I know you're tracking the count, right? But, if I'm looking at my other stocks or my brokerage account or whatever I'm doing, I'm generally just looking at the moving averages. So price and volume, always a given. Price and volume.
Yep.
Then it's moving averages and trend lines. Yeah. And I'm going, okay, well, ding, ding, ding. That thing is not, it broke the trend line. It does not look like anything else.
Right.
And it's great if you're in it, but when are you getting out? Because it's going to go somewhere else.
Right.
And it ain't going to be like straight up.
Right. So let me just answer that question right there. When are you going to get out? So, and you said that what you thought separated me from other technical analysis was this emotional thing. What I think separates me from other guys that do technical analysis, I'm not saying when to get out. I'm saying I'm observing when I'm getting out when the trend changes.
Yeah.
Like
you're not going to try to guess when to get out.
No. I mean, I'm going to do the Elliott wave projections and I'm going to have my targets and all that. Yeah. But I'm not getting out until the market tells me to.
And that is where those other indicators are very helpful, because once you throw the Elliott wave in there and you kind of know where you're at, right? So you're in this 5 leg or this 3 leg. You also, the great thing about the Fibonacci numbers is, again, they're just patterns, they're math that says, generally speaking, if this happens, this is where it's going to go to. And if it passes that, it's going to go here. If it passes that, it's going to go here, whether you're going down or up. And so that gives you lines in the sand easily to go, oh, if it passes that, I know we're in a 3, I know we're in a 5, I know we're going to get a correction. Oh, it just passed below this thing, I'm out. And that's kind of where you're at, right? It's like I'm not trying to figure out when I'm going to get out when it tells me to get out.
Right. Exactly right. Yeah. Okay. So those are the two long-term possibilities. Either way, whether it happens in the next several months, I have no idea. There are other projections that you can do that put the 3. So if this is a 1, A, B, C is 2, this 3 can be up here at 5,400. And then we get a 4-5. Because if you do a 1.618 extension from the 1, a 1.618 extension of the 1 from the bottom of the 2, you get up here at like 5,400. So there are a ton of different ways you can look at this, and I'm not going to get into all of it on the show, but these are the two primary counts that I'm looking at right now. Okay. Bonus chart is the NASDAQ only because, seeing as how we're staying on the Elliott wave theme, I just wanted to point this out. The NASDAQ is the tech index, right? So here was the COVID crash, and we had this huge move in the NASDAQ. We were down here at 7,000, and we're more than double at 14,700. So since the low after COVID, we've more than doubled on the NASDAQ.
And a lot of fundamental analysis people would look at that and say, hey, we completely understood this was going to happen because tech became so important.
Oh, yeah.
After, quarantines, right? After people can't go anywhere. If we didn't have this technology, we
wouldn't be able to function.
Yeah, everything would have came to it. You think it came to a standstill, restaurants and hospitality industry and those kind of things went down, but tech went through the roof because you had to use it. Yeah. You didn't have any choice, right? And so most people would think, well, that was a no-brainer. Like, we saw that coming. Yeah. But how long is it sustainable?
Yeah. I mean, it's obviously this consumer sentiment doesn't think it's sustainable for much longer, you know. But so in terms of Elliott wave, I just wanted to point this out. So if this is our 1, ABC is 2, 3. This 3 is shorter than the 1. And we know that wave 3 can't be the shortest wave. That's one of the 3 absolute rules in Elliott wave. So if wave 3 can't be the shortest, it means wave 5 has to be shorter than both 3 and 1. And right now, we are at 1, ABC is 2, a shorter 3, ABC is 4, and a 5 that's shorter than both of them. So,
again, looking for a correction.
Yeah. It doesn't mean it's going to happen. But I am
and you
watching it pretty closely.
Look at those other indicators down at the bottom,
Yeah.
and you start to see, are they getting ready to roll over?
Yeah. I mean, you can see that we got overbought at the 3, which is very typical. Then we had the 4 consolidation. We did not get higher, so we have a lower high on the relative strength, even though we have a higher high in price. Doesn't mean that the market's going to roll over. It just means that the momentum is waning, right? Back here, we had a lot of momentum as price was going higher. Now we still have price going higher, but momentum is decreasing. MACD is lower. Stochastic is still good, but if it drops below 80, and MACD rolls over and relative strength rolls over, so does the price.
Big indicator, exactly.
Yeah.
And you want to be watching that while you're watching everything else.
Yep. Okay. TSP fund charts. All right. So, like we've been saying for weeks, if you're watching your TSP on a weekly basis, which is a good way to do it. I mean, I'm doing it 10 times a day. Not the best way to do it, honestly. If I was still working, I would just probably do it weekly. But
even once a day is not that big a deal.
Yeah, right. But I'm just saying, on a weekly basis, until the C fund closes below that 10-week moving average line, there's no reason to get out of the C fund, to get out of the stock market in general, really. But this week, I'm going to zoom in here. This week we came all the way down, hit that 10-week moving average line, and came back up. It finished down, 0.59% for the week, but it could have been much worse. It came down by Wednesday, I think it was, hit that 10-week moving average line, and then recovered on Thursday and Friday back to not new all-time highs, but recovered a lot of the losses. Until we get a close, until we get a close, sorry about that. Okay, it does not want to.
The computer's fighting him.
Give me a second. Okay. Until we get a close below the 10-week moving average line. So, it doesn't have to be down here at 4,200, but somewhere down here that clearly takes us out of this trend. I would quote unquote let it ride. Once we get a close on a weekly basis below that 10-week moving average line, things have changed. It doesn't mean that it can't drop down here for a minute, stay down here, and go higher. Because as we said, that's what we're kind of expecting, right? 1, ABC is 2, 3, some kind of correction here for a 4, and then a 5 is my primary count. But at some point, when we get a weekly close down here below that 10-week moving average line, we are going to be in the 4 leg, whether it's a 4 sideways or a 4 that comes all the way down but can't go below here, right? So you get the idea. Okay. That's the C fund. S fund has been in this sideways consolidation here almost for the whole year. I was pretty optimistic over the last couple of weeks that the S fund was going to break out to the upside, but it did not do that, and that actually is what precipitated the alert on Monday. So if the market does move higher, the S fund will definitely move higher with it. You can't have the S fund going down and the C fund going up, not on a sustained basis anyway. I fund, I don't know if I like like is a bad word, but I would say 1, 2, 3. I don't think this is enough of a 4. So I don't really have a good Elliott wave count for the I fund. But either way, we got sort of a double top right there. This week was a pretty significant down week for the I fund. It didn't close at the low for the week, so that's good. It closed right on its 10-day moving average line. So technically the I fund's still in good shape on a weekly basis. And of course, some people are going to be watching this going, "What are you talking about? You got out of the stock funds on Monday. How can everything still be in good shape?"
Yeah.
Right? I think if you don't even have to listen between the lines, right? We're saying we're expecting that we're either at a high or really close to a high, and I don't want to lose money. So when I don't want to take that loss that proves to me that we're in the four leg. I'm trying to get out before that. I don't want to take any of that loss. Right. So, this week we
had the moves for it too. That's another important part. Right. Because where we're at in the month, we've got plenty of moves left.
Right.
Plenty of things we can do. It's a tactical decision. It's like, okay, now if we'd already used 2 moves, it's a lot different.
Yes.
Right. But we can get in and out a couple more times.
We very well may.
Yeah.
Ding, ding, ding. We might just do that.
Are you stomping your foot right now?
Yeah, kind of. It depends what happens on Monday morning. So if you're a subscriber to the site, I'm sure Sherry's laughing right now. She's going to be watching this laughing like, I knew that was coming.
Yeah.
F fund, we moved 50% into the F fund last week, and it was the only fund that went up for the week. So
imagine that.
We did pretty good there in the F fund. All right. You got any questions?
I don't have any questions. I'm sure after folks watch this, they're gonna have some questions. I hope they do.
Yeah.
I really like it when the chatter goes up in the public group. And for you guys watching, we have a members only group on Facebook. If you're a member of our site, then you're in that group, and we talk a little more freely in there about our alerts and things like that. On the public side, we don't. We try to keep it just plainly educational.
Yep.
Right. And so we actually did a Facebook Live this week. It's in our Facebook group. You can kind of scroll back through and find them. I forget exactly how to find them. I know they put them all together. But anyway, it's there. I'm also going to send it out in an email this weekend. So anyway, if you missed that live stream, go check it out. We get into some of the topics that people talked about on Facebook this week. Hope you enjoyed the show, and if you did, please share it with your friends.
Absolutely.
And hope you guys have a great week.
Yep.
All right, man. We're out of here.